Welcome to the deep dive. Today we are focusing on uh, a real legacy company in the world of medical technology. A giant that's, well, spent the last few years stumbling, but maybe is attempting a pretty high-stakes turnaround. Baxter International, ticker BAX.
Right. Baxter, historically, absolutely critical to global healthcare.
Yeah, founded way back 1931. They were the first to commercially produce prepared IV solutions.
Oh,
I mean, think about it. They're sort of the essential plumbing of hospitals, right?
exactly. Everything from surgical tools, smart beds, those life-saving fluids.
Yet if you actually look at their chart, it tells a really painful story. The stock has just been absolutely crushed, plunged over, what, 75% from its peak?
Yeah, and it's more than just a stock drop, It really points to a failure of execution, maybe structure, too.
How so?
Well, Baxter was just bogged down, lots of debt, constant supply chain crises. I mean, everyone remembers the Hurricane Helene disruptions and just operational complexity, holding too many sort of disparate businesses. That massive kidney care division, for instance.
And the market has certainly priced that failure in, no question.
Hmm.
Currently, BAX is trading at a, well, frankly, a shocking discount. We're talking less than 8 times normalized free cash flow.
Which is crazy when you think about it. Historically, since about 2005, their median multiple was around 24x.
Wow. That dramatic swing, that tells you everything you need to know about the market's current pessimism, doesn't it?
It really does. And that pessimism basically sets up our mission today. We were given this pretty aggressive investment thesis targeting over $70 per share.
$70 plus. That's a colossal gap from where it is now, right? The market cap's around $11.17 billion.
Exactly. So we need to really dissect these Q2 2025 financials, look at the recent strategic moves, especially, the spin-offs, the arrival of this highly touted new CEO. Can they actually bridge that gap?
Right. The core question is, are these real turnaround agents or, just cosmetic changes?
That's what we need to figure out.
Okay, before we get into the strategy itself, let's just lock down the core business. Post-restructuring, what is this new, leaner Baxter actually focused on?
They're really zoning in on essential, repetitive, critical care needs. Think of
Yeah.
their portfolio like hospital infrastructure,
Yeah.
supplying the sterile IV solutions, the infusion systems to actually administer them. They handle blood management, patient monitoring, critical connected care platforms, and importantly, they're still a major player in advanced surgery.
Right, things like hemostat sealants.
Exactly. Highly specialized, often high-margin products used to stop bleeding in complex procedures. It's a foundational role, really non-discretionary in global healthcare.
Okay, foundational, non-discretionary. Got it. So let's unpack this new streamlined Baxter based on their continuing operations revenue mix.
Yeah.
Using those 2025 figures should give us a clearer picture, right? Post-spinoff.
Right. So starting with the biggest piece,
Hmm.
metal products and therapies, that's about 47% of total revenue. This is really the bedrock of Baxter, all the essential high-volume consumables.
And consumables here, we're talking sterile IV solutions, administration sets, the basic fluid delivery stuff.
Yeah, that, but also parenteral nutrition, that's vital.
IV feeding, basically, for patients who can't use their digestive tract.
Exactly. It's complex, often custom compounded, usually means higher barriers to entry, reliable, probably high margin revenue. This segment, it's really the definition of stability in medicine.
Makes sense.
Then you shift over to the systems and capital equipment side. That's healthcare systems and technologies. Accounts for about 27.3% of revenue.
This is the modernization piece, right?
Right.
Connected care solutions, integrating patient data.
Precisely. Smart bed systems, advanced surgical equipment, visualization tools, precision accessories, that kind of thing. This is where, future digital growth is either going to thrive or, frankly, wither.
Okay. And finally, the segment that maybe flies under the radar a bit, pharmaceuticals.
Yep, 21.8% of revenue. But crucial specialized revenue here. They're a significant provider of specialty injectable pharmaceuticals, inhaled anesthetics, and these essential, high-demand drug compounding services.
So the last little bit, 4%.
That's mostly transitional or service stuff. Manufacturing and service agreements, MSA, and some residual revenue from the Vant-Iv business they just divested.
Got it. So the key takeaway here is that, 96% of Baxter's focus is now squarely on non-discretionary medical products, products that face, theoretically, massive secular demand.
That's the crux of it. And that's the argument, right?
Hmm.
Why shouldn't this stock be trading at 8 times cash flow when its core products are absolutely necessary for modern medicine and the demographic drivers are just undeniable?
It seems like a mismatch.
It is. This secular tailwind, this is the why it's interesting factor. It's almost independent of management competence, driven by aging global populations, rising surgical complexity, the increasing reliance on integrated electronic monitoring. I mean, the sheer growth forecast for these markets is...
Well, it's phenomenal. Let's put some numbers on that. IV Solutions, the foundation, valued at $13.9 billion in 2024.
Right. But get this, projections show it nearly doubling, surging to $29.6 billion by 2034.
Doubling. Wow.
That implies an aggressive 8% compound annual growth rate, CAGR, doubling the market size in a decade. That's massive volume Baxter's positioned to capture, almost just by standing still if they execute.
And that volume needs delivery mechanisms, right? So infusion pumps.
Similarly robust, valued at $19.9 billion in 2025, projected to hit $28.3 billion by 2030. That's a 7.4% CAGR.
And Baxter's focus on the new Novam IQ platform positions them right in that accelerated market.
Theoretically, yes. If, and this is a huge if, we'll come back to if they can fix the platform's regulatory issues. If they can, they are poised for major upside there.
What about the pharma side? You mentioned strong growth there.
Oh, yeah. The strongest tailwind in their whole portfolio, actually, the generic injectables global market, projected to skyrocket from about $40.6 billion in 2025 to $67.3 billion by 2030.
$67 billion.
Yeah. Clocking in at a stunning 10.69% CAGR. That's the highest growth rate of any segment they operate in.
Why so high?
Well, that 10.69% CAGR is crucial because it shows healthcare systems worldwide are rapidly shifting toward generic, high-volume injectables. It's about cost efficiency. Baxter's ability to manufacture at scale should give them an inherent competitive advantage. Again, if they can keep that supply chain reliable.
Reliability seems key. And don't overlook their advanced surgery division, right? Maybe smaller, but important.
Definitely. That specialized hemostats market-controlling bleeding projected to grow from $2.7 billion in 2023 to $4.9 billion by 2032. That's a solid 6.8% CAGR. These products are high-margin, highly specialized, insulates them a bit from commodity pricing pressures.
And even their newer focus area, connected care and smart beds.
Also strong. Projected for a robust 7.4% CAGR over the next decade, driven by that shift towards remote monitoring, hospital efficiency.
So bottom line, if you look at the source material, every single core market BAX operates in is expected to grow somewhere between, almost 7% and nearly 11% annually.
Exactly. The question isn't really whether the opportunity exists. It clearly does. The real question is why Baxter, with this phenomenal foundation, couldn't capture it before. And are they now structurally capable of actually doing so? That's the turnaround story.
Right. That structural inability to capitalize, that's why the stock got battered. They were complex, slow, operationally brittle. Just couldn't execute.
Which connects right back to the simplification strategy. That was step one in fixing the foundation.
And it was pretty radical surgery, wasn't it?
Oh, absolutely. The core move was spinning off that Vantive kidney care business, completed January 2025, and they also divested their biopharma solutions unit.
These were big pieces.
Huge, large, capital-intensive, often lower-margin operations that were frankly masking the performance of the core medtech business.
So the goal wasn't just selling stuff off randomly. It was about creating a leaner core.
Precisely. By focusing only on medical products, healthcare systems, and pharmaceuticals, the hope is they unlock higher margin growth paths for each of those remaining businesses. But the immediate, tangible benefit, the cash.
All right, the Vantive spinoff brought in over $3 billion in proceeds.
And that cash was immediately put to work addressing the underlying disease, that massive debt pile.
How much did they pay down?
Baxter repaid approximately $3.8 billion of debt through the first half of 2025. Used the kidney care sale proceeds. That included dealing with a EUR $600 million bond maturity in Q2. That debt load, it was a huge drag on their valuation, their flexibility.
And debt repayment, it's more than just, a confidence booster for the market. It's a necessity, right?
Absolutely. Crucial for preserving their investment grade rating, keeps their borrowing costs low. But critically, reducing those interest payments frees up hundreds of millions annually.
Which can then be redirected.
Exactly. Away from debt holders and towards strategic R&D acceleration. They need that financial flexibility to go back on offense, as they say.
Which brings us neatly to the ultimate turnaround agent, perhaps, the new CEO.
Andrew Haidider, appointed CEO July 2025, fully took the reins by September 3rd. His arrival is arguably the market's biggest bet on actual execution improvement.
Let's unpack why the market seems so bullish on him. It's not just a generic, good resume, is it? His track record at ATS Corporation seems like a blueprint for what Baxter desperately needs.
It really does. From 2017 to 2025 at ATS, he grew adjusted revenue aggressively, sure. But the real magic, the thing everyone points to, was the margin expansion.
He took operating margins from what, something like 4.6%?
Yeah, up to 8.1%. That kind of margin growth indicates deep operational control, serious cost discipline. Not just cutting fat, but fundamentally changing how things run.
And that transformation directly correlated to shareholder returns, right? The ATS stock basically tripled under him.
Yep, delivered about a 225% total return. Because that margin expansion is what powers the valuation multiple increase, you see. So how'd he do it? Haidider implemented something akin to the ATS business system.
Which focused on?
Relentlessly on lean manufacturing, modular design, cutting administrative bloat. This isn't about one-time cuts, it's about fundamentally changing the operational culture, making efficiency just part of the DNA.
So his mandate at Baxter is basically a direct translation of that successful blueprint. Attack Baxter's specific known weaknesses.
Exactly. First, cut the stranded costs. All that overhead, IT, admin infrastructure left over from supporting the massive Vantive business. It's just sitting there, dragging down margins.
Okay, makes sense. What's next?
Second, and this is vital for actually executing in those huge growth markets we talked about, he must modernize the supply chains and, critically, harden manufacturing.
Harden manufacturing. That sounds like jargon, but what does it actually mean?
It means investing heavily to prevent the kind of disruptions we saw from Hurricane Helene. That knocked out a major Previe production site, triggered months of allocation issues, lost sales, damaged credibility.
So hardening means what? Building redundancy.
Precisely. Implementing dual sourcing strategies so if one site fails, another can ramp up immediately. Significant automation investment to reduce labor dependency and variation. Potentially diversifying production geographically, moving away from those single points of failure.
It's a shift then, from maybe brittle, purely cost-optimized manufacturing to robust, reliability-optimized manufacturing.
Exactly. That shift is essential if they want to capture those massive underlying KGRs we keep mentioning. You can't sell what you can't reliably make.
Is there a measurable objective for this push?
Oh, yes. The big one. Achieving a 16.5% adjusted operating margin in 2025. That's the line in the sand.
16.5%, that's ambitious.
It is. Haidider's targeting aggressive operational discipline to hit that, which in turn frees up funds to accelerate R&D, especially in connected care platforms and those next-gen infusion systems. It's meant to be a virtuous cycle.
Right. Divestitures fund debt reduction.
Debt reduction funds operational cuts.
Operational cuts fund growth R&D.
That's a plan.
Okay, we've established the strategy, the potential, but now we need to check the temperature, right? The Q2 2025 financial results. This is the first real data on the newly streamlined Baxter, reflecting just continuing operations.
Right. And, on the surface, the headlines looked decent, pretty much in line with guidance. Total net sales hit $2.81 billion.
Which was up 4% reported.
Correct. 4% reported increase. However, and this is important if you peel back the layers, the core weakness is still visible. Operational sales growth, which is what really matters, stripping out currency and M&A effects, that was only 1%.
Only 1%.
Yeah.
That feels concerning. We just established that basically every single market Baxter operates in is growing at, 7% to 11%?
Right.
So if the underlying operational machine is only delivering 1% growth in markets, expanding at 5 to 10 times that rate, doesn't that suggest that despite the cleanup, the company is still fundamentally struggling to execute and actually take market share?
It absolutely suggests that the heavy lifting on operational efficiency hasn't translated into revenue acceleration yet.
Okay.
The turnaround seems to be starting with cost cutting, simplification, not yet aggressive top-line growth. But on the profitability side, the story is far stronger. The adjusted operating margin hit 15.1% in Q2 2025.
15.1%. Now, that's the real operational achievement, isn't it? That represents, a 180 basis point increase year over year?
Exactly, a 180 basis point jump. Let's translate that for you. It means they're already converting an extra 1.8 cents on every dollar of sales into profit compared to the previous year.
That's tangible, measurable. A sign that the initial cost discipline, the simplification efforts, getting rid of stranded costs, focusing on higher margin products, it's actually taking hold.
Yeah.
Maybe faster than some critics expected.
Right. And that improved operating leverage flowed directly to the bottom line. Adjusted diluted EPS was $0.59 for the quarter. That's a powerful 28% increase over the prior year's $0.46.
So margin and EPS expansion providing the initial evidence that the simplification is working, even if the top line isn't quite there yet.
That seems to be the picture in Q2.
Okay, let's drill into the segments then. Starting with the largest, medical products and therapies, $1.32 billion in sales, but still only managed 1% operational growth. What happened there?
Yeah, this segment really shows that tension, doesn't it? Between the structural growth potential and the current operational pain points. Their largest division within that, infusion therapies and technologies, actually declined 1% operationally.
Declined. Why?
The primary drivers were probably temporary, but still disruptive. Hospital conservation efforts on IV fluids, basically, a cautious reaction reflecting that post-Hurricane Helene destocking. Hospitals got burned by the last supply crisis, so they held back inventory.
Okay, understandable caution.
Plus, slightly lower than expected U.S. patient admissions played a role too. But within that same challenged segment, there was a positive indicator, a sign of where their internal investment is paying off.
Just
The strength in infusion systems. That seems directly due to the ongoing rollout of the Novam IQ platform. That platform is clearly winning some market penetration, even with that regulatory cloud still hanging over it.
right, the regulatory risk we need to talk more about. But they also took steps to address the source of past failures, didn't they? The supply chain stuff.
Yes, crucially. They confirmed inventory levels at their critical North Cove, North Carolina site, the one hit by Helene, are now fully restored. And they've removed allocation restrictions for all Hy-Vee solutions made there. That's a big deal for customer confidence.
And more importantly, didn't they partner with Vizient?
They did. Vizient, one of the largest hospital group purchasing organizations, they created a formal reserve program.
What does that do?
It basically secures dedicated on-demand inventory, specifically designed to protect against future localized supply disruptions. That is the definition of hardening manufacturing in action. It's a major win for hospital confidence, potentially locking in future volume.
Okay. Meanwhile, the advanced surgery division within this segment.
That remained a reliable growth engine. Strong global demand for those specialized hemostats and sealants resulted in a robust 5% operational growth. That product line continues to be a solid anchor for the whole business.
Good. Moving to the tech side then. Healthcare systems and technologies. Delivered $767 million in sales, slightly better, 2% operational growth. What drove that?
Well, the growth was really concentrated in their push towards integrated care. The care and connectivity solutions part showed solid performance, up 4% operationally.
Including domestic and international.
Yep, noted mid-single-digit domestic growth and even high single-digit improvement internationally. This suggests hospitals are finally making those capital investments in modernization. Ties right back to that big 7.4% CAGR tailwind for connected care we discussed.
But there's a drag here too, right? Frontline care?
Yeah, that's a 1% operational decline. Seemed affected by softness in some select international markets. So it's a bit of a mixed bag. Connected care integration seems to be working, but some of their older monitoring and diagnostic products might be facing pressure. Competition, maybe shifting capital priorities.
Okay. Finally, the pharmaceutical segment. $612 million sales also grew 1% operationally. What's the story there?
Here, the internal dynamics are really critical. The segment's being pulled in two different directions, essentially.
So-
the clear positive driver was drug compounding. That achieved significant 7% operational growth, fueled largely by really robust demand for compounding services outside the U.S.
That service lets hospitals and pharmacies customize meds, right?
Exactly. And demand for that is soaring globally, so that's a real bright spot.
But conversely,
the larger injectables and anesthesia division declined by 4% operationally. The injectables weakness was attributed mostly to a tough comparison from the timing of a large U.S. government order in the prior year.
so if that's truly the sole cause, that weakness should be temporary.
That's the argument, yes. It should wash out. However, inhaled anesthesia sales globally continued to weigh down the segment, declined low double digits again in the quarter. That suggests maybe more structural pressure in that particular product line.
Okay. Wrapping up the financial check. Liquidity. Cash flow. The goal is cash generation to fuel R&D, right?
Yeah.
How did they do?
Well, free cash flow for the first half of 2025 was still technically negative at minus $144 million. But importantly, that was an improvement over the previous year's first half, which was minus $150 million.
So slight improvement, but the key was Q2 itself.
Exactly. Critically, Q2 2025 free cash flow was actually positive $77 million. That marks a potentially pivotal shift back towards generating rather than consuming capital. Small number, but directionally very important.
Okay, so the numbers show some structural improvement, definitely in margins, starting in cash flow, post-divestiture. But this turnaround still feels fragile. What are the major, maybe even existential hurdles that could just derail this whole thesis, regardless of the new CEO?
Number one, absolutely, is the Novam IQ infusion pump litigation and regulatory risk. We mentioned it before, but it bears repeating.
The FDA flagged serious concerns, right? Underinfusion, overinfusion issues,
Yeah.
linked potentially to serious injuries, even deaths.
Precisely. If the FDA mandates a major recall, or worse, effectively pulls the product from the market until significant remediation is done, the commercial consequences could be just disastrous.
It feels existential because they are banking on Novum IQ to capture growth in that huge infusion pump market we talked about.
Totally. Losing their main entry point there, plus the potential for massive regulatory penalties, maybe class action lawsuits, that could wipe out years of cost-cutting benefits. It could kill the credibility of the entire turnaround story overnight.
Okay, that's the big internal risk. What about external factors?
Well, despite the supply chain improvements, you can't ignore macro risks. A deep recession, or even just sustained demand softness that could risk those hospital fluid conservation efforts becoming permanent, or delays in elective surgeries, or deep cuts to hospital capital spending on those new connected care platforms Baxter is pushing.
All things outside their direct control.
Exactly. And we also have to account for mounting regulatory headwinds more broadly. MedTech is notoriously slow for product approvals anyway.
It's getting slower.
Arguably, yes. On top of slow FDA reviews, you've got new frameworks like the EU's AI Act adding huge complexity and cost overhead to their entire digital health pipeline. If their planned R&D acceleration gets hit by delays and rising compliance costs, it just slows their ability to capture those market tailwinds we keep highlighting.
Okay. Any other major risks?
There's also a crucial internal governance risk, I think, specifically around CEO alignment. Andrew Haidider's track record looks pristine, right? But success really depends on his commitment to long-term value creation.
Meaning?
We need clarity on whether his compensation, his equity package, truly incentivizes genuine free cash flow generation and R&D acceleration, or whether it might unintentionally reward short-term earnings management. You know, hitting quarterly numbers by sacrificing strategic long-term growth for quick wins.
That's a subtle but important point, because the company is still carrying meaningful debt, even after paying down $3.8 billion. Haider has to thread a really fine needle, doesn't he?
Absolutely. Fund the necessary R&D acceleration to compete in those high-growth markets, but without jeopardizing their investment-grade rating or their overall financial flexibility. It's a tough balancing act.
Okay. With those risks clearly outlined, Novum IQ, macro, regulatory, line of bell vision, let's look at the forward guidance the company actually issued for 2025. It seems to suggest, maybe, cautious optimism, balancing growth ambitions with recognizing those headwinds.
That's a fair assessment. For the full year 2025, they project operational sales growth from continuing operations of 3% to 4%.
Which is modestly higher than the 1% they just put up in Q2.
Right. It indicates confidence that maybe those post-Helene destocking issues are resolving and the underlying business is firming up. Interestingly, the overall reported sales growth guidance is actually higher, at 6% to 7%.
By the difference.
Primarily due to accounting effects related to the kidney care spinoff and also their strategic exit from the IV solutions business in China. So operational growth of 3–4% is the number to watch.
Got it. And on the bottom line, EPS guidance.
They expect full-year adjusted EPS to land somewhere between $2.42 and $2.52 per diluted share.
Okay. And breaking that down by segment for the full year, operational growth guidance.
They guide medical products and therapies and healthcare systems and technologies to both achieve operational growth between 3% and 4%. Pretty consistent across the board there.
But pharmaceuticals leads the charge internally.
Seems so. They project the pharmaceutical segment will deliver 4% to 5% operational sales growth for the full year.
Which shows clear confidence that, 1, the compounding services will keep surging, and 2, those negative effects from the prior year government order timing will indeed wash out, as they suggested.
That appears to be the internal expectation baked into the guidance.
Okay, finally, let's dedicate the necessary time to really the climax of this deep dive, quantifying that aggressive $76.19 price target.
Yeah.
This is the math, right? The math behind the potential 250% return that makes this whole investment thesis so compelling, or at least intriguing.
Right. The quantification, it really relies on 3 key assumptions playing out over the next, say, 3.5 years, taking us to the end of 2028.
Okay, assumption number 1,
First, they assume Baxter exits 2025 with roughly $11 billion in revenue. That aligns pretty well with their current guidance.
Yeah.
Then, crucially, maintains an average annual operational growth rate of 5% through 2028.
5% annually.
Yep. Compounding that results in total revenue of approximately $12.7 billion by the end of 2028.
Now, that 5% annual growth rate is critical, isn't it? It's actually lower than those underlying market CGRs of 7% to 11% we discussed.
It is, which suggests the model is maybe accounting for some continued market share loss or perhaps some operational friction. But it assumes reliable, modest growth, likely driven by Haidider's R&D acceleration starting to gain traction.
5% growth to $12.7 billion revenue by 2028. Assumption number 2. This feels like the big one.
It is by far the most critical assumption. Massive margin expansion. The thesis projects free cash flow margins hitting 14% by 2028.
14% free cash flow margin. Wow. How do they get there?
It leverages everything we've discussed. The divestitures cleaning up the portfolio, the aggressive cost-cutting driven by Haidider's playbook, and the supply chain modernization delivering efficiencies.
14% FCF margin, though. That feels like a really high target. Can they realistically achieve that in this kind of medtech environment? Constant R&D spending needed, regulatory compliance costs. Historically, Baxter's margins were nowhere near this level, especially post-complexity.
It's definitely ambitious. This target assumes Haidider isn't just successful, but actually transforms their cost structure to rival the best-in-breed medtech players. If he hits that 16.5% adjusted operating margin target in 2025, that provides a roadmap. But sustaining FCF margins that high requires exceptional ongoing capital discipline. It's a huge leap of faith in Haidider's execution over multiple years.
Okay, so let's assume, for the sake of the thesis, they hit that 14% margin on $12.7 billion of revenue. What does that generate in cash flow?
That generates about $1.78 billion in free cash flow in 2028. So the final step is applying a valuation multiple.
And the thesis uses?
The thesis applies a, I'd say, slightly conservative 22x price to FCF multiple.
22 times? How does that compare historically?
It's just below Baxter's historical median, which was around 24x. So it suggests the market will assign premium status, again, recognizing the higher margins, the cleaner business, but still maybe factoring in some residual regulatory risk or execution uncertainty. It's not assuming a return to the absolute peak multiple.
Okay, so take that $1.78 billion in projected 2028 free cash flow, apply the 22x multiple.
And you arrive at a target market cap near $39.2 billion. Based on the current share count, that equates directly to roughly $76.19 per share.
And that is the math. That's what generates the potential 250% total return, or that 44% CAGR over the next 3+ years. But really hangs entirely on the credibility of Haidider's ability to achieve that 14% SCF margin without somehow derailing the 5% growth rate in the process.
That's the tightrope walk. High reward, but very high execution dependency.
So wrapping this up, what really stands out to you in this whole transformation story? We've seen this, legacy medtech giant perform pretty radical surgery on itself, cut complexity, paid down a significant chunk of debt.
Yeah, $3.8 billion paid down. They have these massive, almost guaranteed secular tailwinds in their core products. And they've brought in this proven operator, Andrew Haidider, who literally specializes in translating operational excellence into margin expansion. The pieces are there.
It is a profound story of potential, isn't it? But balanced by that very real, very current risk around the Novam IQ pump and just the sheer challenge of growing the top line in lockstep with that aggressive margin expansion plan. The formula seems clear. Simplification plus operational rigor equals hopefully a higher multiple. But execution is absolutely everything here.
Which raises, I think, the final provocative thought for you, the listener, to consider. It's about capital allocation. That shift is paramount. We saw Baxter use the $3.8 billion from divestiture proceeds in the first half of 2025 strictly for debt repayment. A critical defensive move, no doubt.
Necessary, probably.
But absolutely necessary. But the new CEO's stated goal is to immediately shift gears, right? To put Baxter back on offense by accelerating R&D. So given that the underlying market KGRs are so high, 7, 8, 10%, the big question is, will that strategic decision to prioritize debt repayment first, however necessary it was, end up costing them too much time?
Meaning allowing faster, more agile competitors to cement their market share gains.
Exactly. Before Haidider's R&D acceleration can fully kick in and start delivering competitive new products, the timing of that shift from essential defense to aggressive offense, that might ultimately determine if they ever actually hit that $76 mark or if they get left behind despite cleaning up the house.